So what do we want to know about secondaries, and why is Derrick always scared of them? Traditionally, up until really the last year, secondaries are really bad for stocks. Secondaries are smart for the company. You know, your company, especially like some of those Wall Street bet stocks that had those big moves, one of the smartest things that they could do is to use their higher stock price to raise more money for their ongoing concerns and ongoing operations. So basically, a secondary offering is one of many ways and one of many tools in the arsenal of a public company to raise more money. And how do they raise more money? By issuing more stock, right? So obviously you have an IPO, and an IPO is when a company goes public and they release a certain amount of shares. The amount of shares is called the float. That's how many shares are outstanding. But that's not a static number for the rest of the company's history. For a lot of companies, the float might decrease over time. Why? Because of buybacks. Like Apple is a great example, right? I don't know the answer to this, but I'd be curious to know how much of Apple's price appreciation since, I don't know, January 2019 has actually come from their buyback program, because they are utilizing their excess cash to buy back a ton of stock because they don't have any other good reason or anywhere else to utilize that money in except for buying back their own stock, which, you know, a buyback acts in some ways like a dividend, right? It's like a dividend is used as a method for a company to return cash to shareholders. Instead of just issuing a dividend, they can actually take that money and buy back their own shares, which, you know, it's supply and demand, right? They're on the bid for their own stock. There's going to be less stock available, assuming that you have equal demand and less stock available, the stock's going to go up in price. So that is a way where the float will actually decrease. The way the float can increase is through a secondary offering. So the company issues more shares, right? So it's like an IPO, except it's a 2PO, right? Like secondary offering. So usually what ends up happening on a secondary offering is, you know, same thing. The company will employ an investment bank to issue new shares, and it's usually done at a discount to where it's currently trading, because they need to drum up enough demand from shareholders to actually buy the secondary offering, right? Because otherwise you would just buy your stock on the primary market. But what ends up happening in practice is, when you go back to that supply and demand equation, assuming that the demand stays roughly equal for the stock, you now have more supply. More supply equal demand is going to mean that your stock is going to go down. So up until 2020, which has been a pretty unique year, it's very typical that whatever the stock's secondary price is for the offering, the stock ends up trading even below it, right? So again, FUTU just announced a secondary after the close today. We know how many shares, we don't know what price. Let's say they announce a 162 price as the secondary offering price. Again, a discounted price from where it's currently trading on the secondary market to entice people to want to be able to buy it. What ends up happening is the stock, in a normal market environment, it might trade down to 160, below that. And again, it's just because of supply and demand equation. So for me, very regularly, if I was in a stock and it announced a secondary offering, I might hit out of that stock as fast as possible. Or if I'm flat a name and it announces a secondary offering, I might short that stock as quickly as possible. Understanding, again, oh my God, they just announced this secondary at 162 and it's at 168. And I know that a lot of the times stocks end up having basically failed secondaries where it ends up trading below its secondary offering price. For me, that was like a go-to money trade for a long time. And then 2020, we saw something unique start happening in the second half of the year, where there just became so much demand, especially for a lot of these speculative names, that you would see these speculative names that were flying up, going up 300%. A secondary offering would be announced. There'd be a little blip in the radar. Stock would go down for half a day. And next thing you know, it's continuing its journey for another 600%. So has not been a good idea or a good trade to short secondary offerings over the course of the last, year or so. But I think eventually that'll come back, and we just want to continue to pay attention.